who is a senior research scholar and Center on Global Energy Policy at Columbia University. Christoph, let's just kick off with a sort of general reflection. Oil prices last week firmly consolidating above 70 and beyond, 72 plus. I think the end of the week was 72.69 to be precise. The market is in very confident mood despite minor turbulences here and there.
Yeah, the market seems to be going straight up, and I think what we have is one thing which was expected, two things which were expected. One is the news. One is the rise of demand continuing. Can you hear me okay?
Yeah, perfect.
Yeah, the rise of demand continuing in at least the well-to-do economies, and secondly, OPEC maintaining discipline and phasing this, feeding that demand quite carefully, including the Saudis now apparently getting rid of their surplus of still 500,000 barrels per day extra cuts from previous. And one unexpected thing, which is shale is missing. The shale is somehow missing in action. We discussed this a little bit last time. OPEC supplies increase, the rest of the world increase. US supplies have not really much increased of liquid hydrocarbons. You go down to crude, unchanged picture, you go down to shale, and it turns out it's indeed the shale patch which hasn't come back. Now that's a bit of a miracle, of a mystery, because many people, myself included, have argued that at prices above 55, 60, you will see shale coming back, and then we are back in this world of OPEC shakes versus shale, as the Economist titled a few years ago. Hasn't happened. Why did it not happen? One reason which people quote is that there was this terrible winter with infrastructure being destroyed and frozen over. Partially true. One reason which people quote less frequently, but is also partially true, is that there was this enormous period of restructuring, financial restructuring in the shale patch, with new owners now being more careful and demanding cash returns, not just growth at any price. And so the cowboys are out, and the return kind of takes a little longer. And one reason sometimes quoted is that this is already sort of the first reaction to all this talk of an energy transition, where oil is no longer needed and where the government will not support oil but hurt it where it can. So that's a conjecture which is unprovable. But I think if the truth is somewhere in the middle, and if prices continue to rise and everything looks like it, then the shale patch will be lured into coming back, and it just has a bit of a delay. And we will have to see them coming back now. Drilling rigs going up plus 6 months to at the beginning of 22.
Jorge Montepecchio, president of General Index. Jorge, when we last had you at us at the table here, you called $70 oil. It's got there. But as Christoph mentioned, it doesn't seem to be drawing back any of the higher cost producers back into the market. Your thoughts, week in review.
Yeah, good morning. And it's very good to see you, to see Christoph, seeing that the thoughts we had initially on the price direction were generally constructive and met by the market. We're going up, and we continue to go up. This is a run. The market is extremely fundamental. If you're an economist, if you have a lot of experience in markets over many years, there are years when markets are technical, and there are a few times when they're very rational and just following an economic trend. And we're in the middle of that. This is extremely rational, extremely based on data. We have demand surge, supply contraction, or tempered or cautious, whatever you want to call it, but there is an imbalance, and inventories continue to be destroyed week on week. And naturally, the outcome of that is that prices need to go up, and prices are going up. The speed is, in a way, surprising us all, but that's what a market is supposed to do. It's supposed to bring a price that alters behavior. And the behavior that needs to be altered is either a surge in supply, which is composed of two factors. One is political OPEC, and another one is market-based shale. Shale is not happening, right? Oil production in the US is still 11 million, say, plus or minus, right? So that is not happening. And the reaction by OPEC is very political, very cautious, as it should be. And the demand doesn't care about that. The demand from all of us is we want to drive, we want to enjoy the summer, we want to enjoy the recovery, we want to enjoy the freedom that vaccination even if it's only psychological, gives us. And that creates a gap. And that gap needs to be filled by price, right? So right now we're heading into 80. And from the looks of it, we will pass 80. The only question I have in my mind, and I think some of the economists are in that same track, is how soon it will happen. Based on what I see on the roads, based on what I see on the pumping of the economies by central governments everywhere, this run is on. It's on until a customer somewhere says it's enough. And that customer is not going to say it's enough at 70 or at 80 or beyond 80. We're still way below where the pain happens. There is some noise out of China, but China has very limited options, right? They have a booming economy. Their need for energy is growing. They may be angry about the price.
And ultimately, they have a pretty strong currency and a weak dollar, which is kind of underpinning this moment. Christoph, do we need to recalibrate how we analyze? I think that's probably what we've been doing all year. But the idea that we have to look at the Fed differently, we can no longer sort of use the same references now in a zero interest rate world. Similarly with oil, even though there is 6 to 8 million barrels of idle capacity on the sidelines, any time in the past that has been present, oil prices have been declining and they would be very weak. On this occasion, it's not the case. How do we recalibrate that? Do we have to look at the oil markets differently now, and that idle supply is no longer a bearish component?
No, I don't think we need to, throw the whole framework out of the window. I agree with José's conclusion that prices are going up at the moment. It's pretty obvious. I completely disagree with his reason for it. This is not a market, which is squeezed into short supply. This is a political decision of OPEC to continue to keep supplies short and take the money off the table. It is the whole analysis of what we said of demand being market-driven, so to speak, and now unconstrained, and OPEC being a political decision to when to release supplies and so has not changed. What has changed is one detail, which is that shale took longer to come back than everybody expected, and that I think raises the question: what is OPEC going to do? And of course, they're going to ride the horse until it collapses. So they will take as much money as they can before shale comes back. Remember. This is now the downside of a politicized market. Remember months and months ago when all this started with this meeting in April 22. And the question was, should OPEC Plus have a giant cut and endorsed by the rest of the world, or should the chips fall where they may and markets do the dirty work? If markets had done the dirty work, the price decline would have been much more severe, but it would have been probably over faster because nobody would have had a reason to hold back like these shale producers now. Now with OPEC made for a smooth ride, which was also good for them and probably for the world, but it now continues longer than it would without the presence of a producer association constraining supplies. That's pretty obvious to me. So the miracle is, the mystery, sorry, not the miracle is, where's shale? And I still think that they will come back. I don't think they have disappeared in thin air. And then we were back to this world. And then the real question is what will happen? And then it becomes interesting how OPEC reacts to that.
Jorge, we had on Bloomberg Intelligence last week, Mike McGlone, who was saying that I can't remember the number of years, but certainly it has been many years since it's been this profitable to produce oil in the United States. The cost versus the margin seems to be very, very attractive. And yet the major actors are not taking advantage of that. Are they in any way being neglectful of their fiduciary duty to maximize profits by not producing oil at this time?
No. Any oil company has a reservoir from which it is producing, and then it has midlife oil fields, and then the marginal ones, which are, as Christoph has been noticing or talking about, is shale. In the base, you produce as much as the reservoir allows you to. The producers are not constraining production in the US or in the offshore oil fields globally. They're just doing their job. What they're not doing is optimizing or maximizing the entry into the shale field. And why aren't they doing that? Because it's not profitable. You cannot get truck drivers. You cannot get pipes. The price of steel is rising 100% year on year, or roughly in that manner. So the whole cost structure is rising alongside the price of oil. So it's not like marginally they're making more money. They're optimizing as hard as they can. They cannot go beyond the constraints of economics. As I indicated, I think two or three sessions ago, that we shouldn't be too happy or optimistic about shale production in the US, that we already saw the peak because the cost of production is rising too much. One of the main issues in the US, and the US is the shale producer right now, is labor. Labor is extremely constrained. And if you have a job being in a dangerous area, drilling with dangerous products, or having a job that may pay you more elsewhere, you do the other one. I was once in Houston where I think I tell the story. I was with an Uber driver that said, "Why are you doing this instead of being in the shale oil field where he used to work?" Said, "I work with balls of fire because the gas would come out and ignite," right? So if people have a choice in a tight economic environment where labor is short, they do what is less dangerous and more profitable. They're being economical about it. So I think for the group here, we need to factor in that supplies from OPEC are constrained and supplies at the margin from shale are constrained. And normal production by IOCs it has a long timeline, and these oil companies are getting beaten up by the legal system and by the investors that they need to do some other kind of other economic activity. And result is oil is tight and demand is strong. So we're going up and further up.
Christoph, we had the IEA call on OPEC to open the taps. I haven't heard that declaration from them in a while. Clearly, they see demand surging. They're recalibrating upwards in their demand forecast. What are your expectations for these sentiments, not only on non-OPEC plus producers, but OPEC plus themselves?
Well, I think generally we are in for, at some point, to get some severe backlash against all these, energy transition arguments of having to curtail oil production and getting Western IOCs out of the business and into wind instead and all that. The way I looked at this IEA, so the IEA is also contradicting itself. I'm coming out with this big report on the blueprint for decarbonization versus now saying we need to open the taps, but let that pass. When you look at that report, the way I read it is as a single declaration that this is not going to happen, it's not possible, and forget it. It has been perceived by journalists, by the industry, by everyone, however, as a blueprint. We need to tighten belts. We need to be more on the ball. We need to do more for the energy transition and all of that. And I think when you overpromise, this is the case here, then you get some cynicism at best and some political resentment at worst, and that's going to come, and that will include the discovery that maybe it's not a good idea to turn off oil production before you have found subsidies for a replacement for it. And this is what happens here. The supply side has been told now for a long time to cut it, but on the demand side, there is no way of replacing it. And that's creating one problem. And then specifically what the IEA has in its report written itself, oil production and gas production is becoming more concentrated as an effect of that. The IEA predicts in its report that if the world goes to that pathway for a net zero economy, that OPEC share of global production goes to about 50%, much higher than it has ever been. Similar developments in gas and so on. I think these are things which just show that now it's very much on group to be in favor of the energy transition, but it's falling a little bit ahead of itself. It's not really thought out very clearly. And the beneficiaries at the moment are those who have held the course and sitting now on oil production possibilities and saying, we go ahead because we believe oil will be needed in the foreseeable future. And I think they will be right.
Jorge, we've sort of been operating on the assumption generally that OPEC Plus were happy to target $65 oil, that they were keen to add supply back on the market while defending 65. Do you think that remains the case, or what's your calibration? And we also had this, at essence, the target of the 5-year average in terms of inventories. Has the OPEC Plus targets moved, or are they getting a little bit greedy? What's your assessment of this fairly robust bullish posture they've taken?
I think we can only speculate internally about what their targets are. But based on long-term discussions, many years ago, they felt that at $80, you could really discourage shale production. That was their long-term goal. In the short term, what you see is that they need the money. We are now in a 70+ environment. And as far as we can tell, most major forecasters are saying we're still in a constructive environment. We are going up. So you could say OPEC should be relaxed, right? What are they doing actually? So don't focus on what they should think, what they say they are going to do, but what they are actually doing. Saudi Arabia is raising additional money from the sale of bonds. Qatar, who has a lot of demand for LNG, the best year ever was last year, and this will be better than last year, is also raising money. So that means that where the prices are is not enough. They still need more money. They suffered very badly last year. The economies are still recovering. So if they can see 80, of course they will welcome it. If they can see 100, they'll be very happy, right? So that just reduces the need to raise additional funds. I think they're just going to welcome it. So from a policy point of view, and we need to look at Saudi Arabia as the kingpin in this situation, they're going to act with temperate. They're going to be slow in bringing in additional supplies of oil. And this means that the inventories are clearly going to be below the 5-year average. And then we're going up until a customer says enough. China is the only one making noise, but they don't have options.
Christoph, we've just are coming through the weekend of the G7 meeting. I mean, there's a few notable takeaways of it. One was, it seems they're doubling down on more stimulus, and also some kind of a call for vaccinations worldwide. Your takeaway from the G7, anything of note?
I think this is another chapter another chapter in the book of how the Biden administration brings the US back into an international leadership position, and how they are actually moving fast, efficiently on a very different fronts. That's his first trip abroad. And what he does is, he addresses a whole host of issues which have been left by Trump on the agenda as unresolved. He was taking the steam and the pressure away from this NATO discussion, where Trump was pushing around the Europeans to increase their contributions. He is trying to fix the Iran situation. He is trying to fix the Nord Stream 2 situation, with the pipeline situation, where we probably see the US caving in. And all of that is very much welcomed by the other G7 guys. And then, of course, we distribute some vaccines on the side, and we have further unspecified, no numbers, no commitments. Just we have some more stimulus. That sounds good. Everybody is happy about that. But I do think it's kind of admirable how fast and swift and by and large consistent the US administration, whether one likes it or not, has moved on all these different fronts. And this whirlwind tour with the G7, and at the same time putting China and Russia a little bit more in their place, is just confirming the picture of a very well-crafted sort of public way of doing business.
I've heard it commented in the States. I've heard it commented in the States by the sort of talking heads of US leading media, that they've been surprised by the discipline of the White House messaging, and that given Biden's sort of noted for his gaffes, quote unquote, that there hasn't been too many. Let's get the survey question before we look to the week ahead and see where the view in the room is. there is a prevailing statement from epidemiologists. I can never say that word or probably even spell it, but we are not safe until we are all vaccinated. That seems to be the mantra, right? We're not safe until everybody's safe. My question is, do the financial markets believe this? That's my question to everybody this morning. Do we believe the epidemiologists we're not safe until everybody's safe? Do the financial markets believe this? And let's turn to the week ahead. There's three things, Jorge, in the week ahead that I've sort of noted. One is the Fed are meeting. Two, Prince Abdulaziz is going to Wall Street, which is sort of seems like nearly the title of a play. And three, we have Putin meeting Biden in Geneva. I mean, there might be many million of other things, but there's three things just to throw out there for you guys to think about. But Jorge, in particular, I'd welcome your thoughts on what do you think Prince Abdulaziz is going to tell Wall Street?
He's going to tell them that the world is very rosy, that prices are going up, that the independent oil companies are not producing enough and are likely to shrink, and that the place to invest is Saudi Arabia. He is going to be a salesman, and he has a good pitch. This is the best time for Saudi Arabia right now to sell whatever they want to sell. If they want to raise funds, they can. If they want to sell additional shareholdings in the company, they can, because the independent oil companies are under the cosh.
In terms of the last time he sort of spoke directly to Wall Street in the last year, not directly in the same sense, he's literally going to New York and making a speech, but his commentary through the year was, don't dare short this market or it will be the infamous quote, ouchie or ouching for you or whatever it was. Has he won on that battle?
100%. And he meant every word he said. If you look back at Abdulaziz, he has committed to a certain level of production and delivered on that. He has committed and was very public about reducing the level of overhang in crude inventories. Take the man's word for it. There is no need to overthink. He has been very clear. He wanted supply to meet demand and under to drive inventories down and for prices to go up. The message is the same. Bet on it. And don't bet against him.
Well, and don't bet at all, perhaps. Christoph, the Federal Reserve Monetary Policy meeting next week, as we sort of sit, as noted on this call this morning, in this Goldilocks market environment, as it's been referred to as, can we expect anything from the Fed? What are your thoughts?
On the Fed front, you would expect continuation of this, of what we have right now. They will, as always, be sort of asymmetric in not rocking the boat when they don't have to. And if anything, they'll probably be late in tempering. But right now, they seem to get through with their message of saying that this inflation is a temporary blip and don't worry. And there's still scope in the labor market, 7 million people less employed now than they were 2 years ago. So there's still some slack. But let me come in also on this, on the back of that, to the oil market situation with two comments. One, if Jorge is right and the shale slow response is because of high labor costs, high capital costs and the like, then it's a matter of time again until it will be fixed. I find it hard to believe, given that slack in the employment which they still have in the US. But when you look at the question, was Abdulaziz right? Yes, he was, I completely agree. But you need to look at the beginning of that movie and then ask for the sequel. The beginning of that movie was, we are now getting what some of us discussed we would be getting if we leave it to OPEC to fix the market. At some point, the goose is becoming the charge of the garden. Or the guard becoming a gardener, I think there's an English saying like that. What's the sequel of that movie? How will this continue? If you put yourself in OPEC shoes, you think that at some point these shale guys that have died will come back, maybe at very high prices. You'll do two things. You'll take the ride as long as you can, and you take as much money as you can, of course. Jose is right on that. But then you also have to think for the day X. And I think the sequel of the movie is, when they come back, you make their life difficult. And how do you do that? You crash the price right back down. And then they will have problems financing themselves, and they will sort of back to square one. And you can be much more flexible than that. So I would think at some point, this run-up will end with a huge burst of volatility.
Jorge, Putin meeting Biden this week, and is there any expectation, any Iran talks could be enhanced by it, could be curtailed by it? Do you see any sort of geopolitical breakthroughs or consequences of this meeting?
I don't think so. If anything, I have been surprised by Biden's strident position globally against China and Russia. I was hoping that we would get into a more peaceful environment with the Biden's administration. But I see the actions by the US Navy and the rhetoric very strong against China and very strong against anyone who stands against the US. And I think the world has changed. China is a grown-up. Russia is in a much stronger position than it was 10 years ago. And therefore, there are going to be very hard discussions where the world is not unipolar anymore. So if there is a huge fly in the ointment for me about where we are heading, one is the impact of inflation, which I have been discussing, right? All the distortions inflation causes. And the other is the prospect that military friction is going to increase over the next 3 years. I was very mindful. I am in the UK, and Biden came here, and his first visit was to a military base. And that delivers a message, right? Whether it's intended or unintended, but I know they think about these things, so those things concern me.
Yeah, he's communicating to the British government, don't you dare destroy the Northern Ireland Peace Treaty. That's what he went at. Only joking, of course. But follow up, Jorge, on other two stories we have in the digest today. One about traders leaving ExxonMobil, and Trafigura calling for more transparency in commodities trading. Your thoughts on either of them? Clearly, the trading firms are making a lot of money at the moment. Maybe not at ExxonMobil, but...
Yeah, well, in a market that was in contango earlier, a lot of oil companies try to benefit from that. And you could say that Exxon participated in that process. But culturally, it's very difficult to have a trading outfit within a old-style oil company, because you have to have different salary structures for the trading side versus the normal
operations
standing employee. So those frictions, of course, don't work very well unless you're really set, almost like to have two companies within one. That's very, very difficult to do. So, and the other issue that you raise about transparency, of course, the whole world is very transparent. We can see more. We can see where a ship is loading, where it's going. Of course, there will always be an element of something we don't see. But that area is reducing and reducing and reducing. So trading companies need to get into that world and act more like an IOC. But it's a long process. It's not going to happen in a year or two, right?
Let's get the survey result and give Christoph the last word this morning. Do financial markets believe this? A big whopping no, they do not. Christoph, what will you be watching in the week ahead? As we mentioned, we have the Putin meeting, we have these other developments. We've got the Iran presidential elections at the end of this week. The Iran talks are kind of in their final days now ahead of that.
I'm surprised by that result, actually, when you think about it. No? Does it mean financial markets think they... Okay, by next week, in that order, in the timely order, I'd say the Putin meeting, yes, and then Iran is sort of important. And in general, when Biden goes home, how the stimulus program passes the vote in Congress, and whether they continue on the domestic front as quickly as they have started. So I do think that right now everybody sits there and waits for inflation to become more obvious, and that will take some time. Right now, those who have expected a major correction in stock markets become more and more silent. So it looks like it's boom time all around in a happy summer. And I don't see the immediate cloud at the horizon who could change that. That's the safest way, say something like that. It's the safest way you could punish by some clouds.
I feel like I should have some orchestra music to play to the backing of that fairly Hollywood ending.
That's when your job gets boring.
I will end with some cynicism and say, despite Jorge's great optimism that he's going to take out his swimming togs next week, the UK are going to be extending their opening of their whatever was meant to be announced on June 21st by a month due to uncertainties around the COVID infection rates rising and so forth. So pesky COVID continues to raise its head in different places to disrupt what seems to be a one-way train, but nonetheless it remains there. Whether it's a factor of note or significance is the question, and I think when it pops up, one needs to pay attention. But I asked the question in the survey today because I do think that is one for maybe not immediately, but over the 6-month horizon. If we're not all vaccinated, are we all not safe? And that's a question I think
How would you have answered it?
I said the answer to the question. I said the markets don't believe it. The markets don't believe the epidemiologists that there is a consequence. And clearly, at the G7 this weekend, one would have to say that the political leadership doesn't believe it either, or else they would have been a lot more profound in their commitment to sharing vaccines around the world. And it seemed to be sort of that typical. It's kind of fallen into the bucket of, aid to the third world. Yeah, it feels good, it makes sense, but we're not really committed.
But don't you think it's everybody understood that, and everybody thinks we're already there? That's what markets think. I was thinking.
You mean think that it's already
recognize the problem, solved it?
Right. Well, I suppose until there's a consequence, as Jorge said, until somebody says, no, I don't want to buy oil at $80 a barrel, or no, I don't want to go to the Maldives on my holidays, this will not be a problem. Yeah, this will continue. But that's the start of a week. Thank you so much, Jorge, for joining us from London, Christoph from Germany, and everybody else. Really appreciate your time this morning. Have a great week. We'll catch up in the coming days. All the best.
Thank you.